Welcome to TheStreet.com TV. I'm Aaron Task, here at the offices of Smart Financial Partners with Joe Capone, a managing member of the firm and a contributor to RealMoney.com, where he focuses in the financial services industry. Joe, great to see you.
Good to have you here.
So last time we were here, we talked about Countrywide Financial. You said it might be possibly a takeover target down the road for Bank of America. You were very sincere about that. You were talking long term, but the other day, big pop in the stock on news that it might be a leveraged buyout target. How much truth do you think there is to that rumor?
I don't believe there's a lot of truth to that rumor, but this is a white-hot M&A market.
Clearly, yes.
And there's been also a lot of talk in the financial press about the buyout of SLM, Sallie Mae. And there was an article in the Journal a couple days ago about how that could really recalibrate the entire market's expectations of buyouts among financial services
Because the amount
companies.
of debt they're able to use with that, right?
The amount of debt and also the ability of private equity vehicles to actually acquire banks, because of safety and soundness and the deposit framework. They generally don't want private equity firms to buy banks, but now there's some possible ways in which they can actually do that if each fund is less than 10% of the ownership of the acquired bank. So there's a lot of talk of things like that, but either way, it's right now in this market, if you have a good franchise and a compelling merger story, I think occasionally these stocks will pop.
Okay, and we were talking before we came on camera about how much option activity is occurring because of that potential and just speculation and maybe people even starting rumors. As a hedge fund manager, how would you or are you playing that?
Well, the first thing is from a hedge fund manager's perspective, you have to be in this market extremely diligent about any shorts that you take. And I have less individual stock shorts, more shorts in ETFs, and I have tight stops. I often buy calls against my shorts in the event that there is a takeout to reduce risk on a dynamic basis. That's number one. Number two, in terms of on the long side, when you see tremendous option activity, it's one of three things. It's either someone wildly speculating,
right,
someone who knows, like the Hong Kong couple and Dow Jones, or and I mentioned this in columnist conversation in Real Money, I think it's possible, and we'll see more of this, some hedge fund managers who are long a stock who want to get out of that stock. Now that if you see 10,000 calls trade in a stock now that's slightly out of the money and going to expire soon, that trade will be on CNBC. That trade will be on RealMoney.com. It'll be on our competitors' sites, and that can move the underlying equity significantly.
Now, before we go further, because there was a similar discussion I had with Jim Cramer once about that caused some trouble. Is this something you're doing? Is this illegal? Is there anything against regulations for a fund to do that?
It's not something I'm doing. I don't believe it's illegal. I think, like with anything else, if you own stock and you're buying calls, I don't think it would be ethical to spread a rumor or anything like that. But if someone buys a lot of calls and then traders jump on the stock thinking that the call buyer knows something, and then that call buyer sells the underlying stock, I'm no lawyer. It doesn't sound against the law.
He's just taking advantage of a frothy market, it would sound like to me.
Right. It's not something that I'm doing or would advocate. I'm more of an investor than a trader, but you have to be cognizant of that. When you see these things start to happen, you have to say, all right, what is, and Cramer says this all the time too, what's the main cause effect, and then where's the pin action? Well, the pin action here could be that every hedge fund on the planet knows if there's a plausible merger story for an equity, they can move that stock by buying the right option and size.
Have you seen this in any specific stocks?
Well, I can't confirm it because you don't really know if then the call buyer is the underlying seller. But I would surmise that it's beginning to happen. And for viewers of this video, I think when you want to be most aware of this is right before expiration, because that's when you can buy these calls for the cheapest amount of money.
Right, because they're about to expire, so their value is presumably worth less. Right?
And presumably also the signaling impact of the call buy is greater, because an observer could say, wow, if this investor is buying all these calls with 1 week to go or less, then maybe they know something.
Okay.
So this is something to watch out for, to think about as you review these call purchases.
Interesting. And in terms of a secondary pin action, perhaps, is there a way to play perhaps what I would imagine is higher prices for calls generally because of all this activity?
I think that there's a few ways to look at this. I think the first is the Wall Street investment banks generally are the sellers of volatility. There's also a recent IPO, Interactive Brokers, that priced last week. IBKR is the ticker. And they had an interesting disclosure in their S1. And in that, they had actually said that they could be hurt by these relatively small dollar options that then tend to explode in price. So they may also be one of the sellers. Now, I'm still not sure if selling these options is a great strategy in this environment. But yeah, I do think IBKR is involved in the sale of some of those options. And I also think going forward, a lot of the Wall Street investment banks sell that volatility and then look to buy it in the other strikes.
Okay. Joe, thanks very much.
Thank you.
My guest has been Joe Capone of Smart Financial Partners. I'm Aaron Task. Stay tuned for more of TheStreet.com TV.